no economic system lasts forever. Throughout history, dominant economic powers have risen and eventually declined, from Venice to the Dutch Republic to the British Empire. Today, we're examining one of the most fundamental economic forces driving these cycles, debt accumulation and its consequences. Debt is not inherently problematic. Strategic borrowing can fuel growth and finance infrastructure. But when debt accumulates faster than economic growth, when interest payments consume ever larger revenue shares, and when borrowing finances consumption rather than investment, the mathematics become unsustainable. This video explores the economic mechanisms behind debt cycles through pure economic analysis: supply chains, trade dynamics, fiscal policy, and market mechanisms. To understand how debt affects economic systems, we must first understand what government debt is and how it functions. When a government spends more than it collects in revenue, it borrows to cover the difference by issuing bonds and treasury securities. Investors purchase these bonds, effectively lending money to the government in exchange for regular interest payments and eventual return of principal. The economics of government debt revolve around key factors. First, the interest rate determines borrowing costs. Lower rates make debt affordable, while higher rates increase costs dramatically. Second, the debt-to-GDP ratio measures debt size relative to the overall economy, helping economists assess sustainability. Interest payments represent significant economic costs, diverting resources from infrastructure investment, education, or tax reduction. When interest payments consume large portions of government revenue, it constrains fiscal flexibility. In many major economies, interest payments now exceed spending on major programs, representing a fundamental shift driven by decades of accumulated borrowing. Debt sustainability depends on a crucial relationship: the interest rate versus the economic growth rate. When growth exceeds interest rates, debt becomes easier to manage. The economy grows faster than the debt burden, allowing stabilization even with continued deficits. However, when interest rates rise above growth rates, debt dynamics reverse, creating a self-reinforcing cycle where higher debt leads to higher interest payments, requiring more borrowing. Economic history provides valuable lessons about debt cycles. The Dutch Republic offers a particularly instructive case study. During the 17th century, the Dutch Republic was the world's leading economic power, dominating global trade, finance, and shipping. Amsterdam was the financial capital of the world, with Dutch merchants controlling lucrative trade routes. The economic foundations were impressive. They pioneered modern financial instruments including joint stock companies, public stock exchanges, and sophisticated credit markets. The Bank of Amsterdam, founded in 1609, became Europe's most trusted financial institution. For decades, this system generated tremendous wealth. However, by the 18th century, the Dutch model faced mounting challenges. Decades of military conflicts drove up government spending and debt. The economic costs of maintaining naval supremacy became increasingly burdensome. Meanwhile, British merchants developed competing trade networks, and British manufacturing eventually surpassed Dutch production. The debt dynamics became problematic. As military spending increased and economic growth slowed, the Dutch government borrowed heavily to maintain its position. Interest payments consumed growing shares of government revenue. By the late 18th century, debt service costs became unsustainable. The government could no longer invest in the infrastructure and military capability that had built Dutch power, creating a vicious cycle. Reduced investment led to slower growth, which made debt burdens heavier, requiring even more borrowing. The Dutch experience illustrates key economic principles. First, debt accumulated during growth periods can become unsustainable when conditions change. Second, high debt reduces economic flexibility. Third, debt service costs crowd out productive investments, accelerating decline. These patterns have repeated throughout economic history. One of the most significant economic shifts in recent decades has been de-industrialization in advanced economies, the decline of manufacturing employment and output as a share of total economic activity. Understanding these economic forces is crucial to grasping broader patterns of change. The economic theory of comparative advantage, developed by economist David Ricardo in the early 19th century, provides the foundation. Comparative advantage suggests countries should specialize in producing goods where they have relative efficiency, advantages, and trade for other goods. As global trade barriers fell in the late 20th century, this principle began operating on a massive scale. The economic incentives were powerful. For companies, relocating production to lower-cost regions offered substantial savings. Labor costs in developing economies were often one-tenth or less of those in advanced economies. Real estate, energy, and regulatory costs were also lower. From a profit maximization perspective, moving production made economic sense. For advanced economies, the aggregate economic impact appeared positive initially. GDP continued growing, unemployment remained relatively low, and consumers accessed cheaper goods. However, distribution of gains was highly uneven. Workers in manufacturing faced job losses and wage stagnation. Communities built around manufacturing experienced economic decline, while workers in finance, technology, and professional services saw income growth. The long-term economic consequences are complex. Manufacturing has historically provided several important functions beyond production. It drives innovation through research and development, creates supply chain ecosystems supporting smaller businesses, and provides employment across skill levels. When manufacturing declines, these spillover effects diminish. From a macroeconomic perspective, de-industrialization affects trade balances. Countries importing manufactured goods must export something else to maintain balanced trade. For some advanced economies, this has meant exporting services, intellectual property, and financial products. However, this shift creates economic vulnerabilities. Service exports often require highly skilled workers, limiting broader employment opportunities. If you're finding this economic analysis valuable, make sure to subscribe for more videos exploring the economic forces shaping our world. While government debt captures headlines, consumer debt represents an equally important dimension of economic sustainability. Household debt levels affect consumption patterns, economic stability, and long-term growth prospects. Consumer debt comes in several forms: mortgages, credit cards, auto loans, student loans, and personal loans. Mortgages represent the largest component and are generally considered productive debt since housing can appreciate. However, economic risk occurs when housing debt exceeds sustainable income ratios or when housing values decline. Credit card debt represents particularly expensive borrowing, with interest rates often exceeding 15 or 20% annually. High-interest consumer debt consumes household income that could otherwise be saved or invested. When households devote significant income portions to debt service, they have less capacity to spend on goods and services, reducing overall economic demand. The aggregate numbers tell a striking story. In developed economies, household debt has grown substantially faster than income over recent decades. Debt-to-income ratios have risen significantly. This shift has multiple economic causes. Real wage growth has slowed for many workers, while costs for housing, healthcare, and education have increased faster than inflation. The economic implications are significant. First, high debt levels increase economic vulnerability to shocks. Job losses or unexpected expenses can quickly push leveraged households into financial distress. Second, debt service requirements reduce consumption capacity, weakening aggregate demand. Third, high debt limits household economic mobility. From a macroeconomic stability perspective, high household debt amplifies economic cycles. During expansions, debt-fueled consumption can accelerate growth. However, during downturns, debt burdens intensify contraction as households cut spending or default. Financial crises are often triggered or worsened by household debt crises. International trade represents a fundamental driver of economic growth but also creates complex interdependencies between economies. Understanding trade deficits, supply chains, and international commerce is essential. A trade deficit occurs when a country imports more goods and services than it exports. From an accounting perspective, money flows out to pay for imports. However, the economic implications are more nuanced. Trade deficits must be financed through capital inflows. Foreign entities purchase domestic assets, invest in businesses, or buy government bonds. The trade deficit in goods is offset by a capital account surplus in financial assets. The economics of trade deficits depend on causes and financing. If deficits result from strong domestic demand and economic growth, they may be sustainable. Businesses import raw materials to expand production. Consumers import goods that improve living standards. However, If deficits result from declining competitiveness or excessive consumption, they signal underlying problems. Supply chain economics has become increasingly complex. Modern products often involve components from dozens of countries. A smartphone might have minerals mined in Africa, components manufactured in Asia, software developed in North America, and final assembly elsewhere. This fragmentation reflects economic optimization. Each stage occurs where it's most cost-effective. These global supply chains generate significant efficiency gains. Companies access competitive suppliers worldwide, reducing costs and improving quality. Consumers benefit from lower prices. Countries specialize in comparative advantages, maximizing global output. However, global supply chains also create vulnerabilities. Disruptions anywhere can cascade through the system. The economic debate over supply chain structure involves fundamental trade-offs between efficiency and resilience, specialization and diversification, cost minimization and risk management. There's no single optimal answer. What's clear is that supply chain decisions have major macroeconomic implications, affecting inflation, employment, and economic security. One of the most important economic questions concerns how growth is distributed across society. An economy can expand significantly while leaving large segments behind, or distribute gains broadly. The economic mechanisms determining this distribution have profound implications for long-term sustainability. Economic growth is typically measured by GDP or GDP per capita, representing total or average output. However, averages can mislead when distribution is highly unequal. If most gains accrue to a small percentage, while the majority sees stagnant incomes, the average masks very different realities. Data from recent decades shows a clear pattern in many advanced economies. Economic growth has accompanied increasing income inequality. The share going to top earners has increased substantially, while the share going to middle and lower income groups has declined. Several economic factors drive this. Returns to capital have increased relative to returns to labor, benefiting asset owners. Technological change has increased demand for highly skilled workers while reducing demand for routine middle-skilled jobs. The economic consequences of rising inequality are debated. Some argue inequality is a natural market result that drives growth by rewarding innovation. Others contend excessive inequality creates inefficiencies and reduces long-term growth. High inequality may reduce aggregate demand since wealthy individuals spend smaller income proportions than lower-income households. It may reduce social mobility, leading to talent misallocation. From an efficiency perspective, what matters is whether resources are allocated to most productive uses. If inequality results from genuine productivity differences, it may be efficient. However, if inequality results from market power, rent-seeking, or barriers to opportunity, it represents inefficiency. Economic literature suggests several factors matter for sustainable long-term growth. Broad-based education, competitive markets, institutions protecting property rights, and sufficient social safety nets enabling risk-taking. When economic gains concentrate too heavily, some growth-supporting factors may weaken. Bond markets represent one of the most important yet least understood components of the economic system. These markets determine interest rates governments pay on debt, influence monetary policy effectiveness, and provide crucial signals about economic expectations. Bonds are essentially IOUs. When governments or corporations issue bonds, they promise to pay bondholders regular interest and return principal at maturity. The interest rate, or yield, reflects several factors: expected inflation, perceived default risk, liquidity preferences, and supply and demand dynamics. For governments with substantial debt, bond yields directly determine borrowing costs. Even small interest rate changes have enormous fiscal impacts. Consider a government with $30 trillion in debt. A 1% increase in average interest rates increases annual interest costs by $300 billion, real money from tax revenue or additional borrowing. Bond market confidence is crucial for fiscal sustainability. If investors doubt a government's ability to service debt, they demand higher yields to compensate for increased risk. Higher yields increase borrowing costs, worsening fiscal deficits, further reducing confidence, creating a potential debt spiral. This dynamic has driven sovereign debt crises throughout history. The relationship between bond markets and monetary policy is crucial. Central banks often purchase government bonds as part of monetary operations, affecting both yields and money supply. When central banks buy bonds, they increase demand, raising bond prices and lowering yields, potentially reducing government borrowing costs and stimulating economic activity. Interest rate dynamics affect the entire economy. Mortgage rates, corporate borrowing costs, and consumer credit all move with government bond yields. When bond yields rise, all borrowing becomes more expensive, potentially slowing economic growth. Infrastructure investment represents a crucial economic decision shaping long-term growth prospects. The economics involve understanding costs, benefits, financing mechanisms, and the relationship between short-term expenditure and long-term returns. From an economic perspective, infrastructure is capital investment. Like business investment in equipment or research, infrastructure investment today generates returns over many years. Good infrastructure, reliable roads, efficient ports, stable power grids, modern telecommunications reduces transaction costs, enables commerce, and increases productivity across the economy. Poor infrastructure creates bottlenecks and constraints on economic activity. Economic returns on infrastructure investment can be substantial but vary significantly depending on project and context. Building a road connecting isolated regions to markets can generate enormous returns by enabling trade and specialization. Expanding port capacity in congested hubs can reduce shipping costs and enable increased trade volumes. Investing in electricity generation can enable industrial development. However, not all infrastructure generates positive returns. Projects in low-demand areas, poorly designed projects, or projects driven by non-economic factors may deliver minimal benefits. The key economic question is not whether to invest, but which projects to prioritize and how to finance them. Infrastructure financing involves important economic trade-offs. Governments can finance through current revenue, borrowing, or public-private partnerships. Financing through current revenue avoids debt but requires higher taxes or reduced spending elsewhere. Debt financing allows infrastructure investment without immediate tax increases but creates future obligations. Public-private partnerships can leverage private capital but may be more expensive. The economic case for debt-financed infrastructure depends on returns generated. If infrastructure generates economic returns exceeding interest cost on debt, borrowing makes economic sense. The investment pays for itself through increased productivity and tax revenue. However, if infrastructure generates low returns, debt-financed infrastructure can worsen fiscal positions without compensating benefits. Economic systems naturally move through cycles of expansion and contraction. Understanding these cycles and their relationship to fiscal policy is crucial for assessing long-term economic sustainability. The economics involve complex interactions between growth, debt, interest rates, and policy choices. Fiscal sustainability is generally defined as a government's ability to service debt obligations without requiring dramatic policy changes or risking default. Several key ratios help economists assess sustainability. The debt-to-GDP ratio measures debt relative to economic size. The interest payment to revenue ratio measures how much government income goes to debt service. The primary balance indicates whether current policy is adding to or reducing debt burdens. No single number defines sustainability, it depends on economic context. A country with strong growth, moderate interest rates, and flexible policies can sustain higher debt levels than one with weak growth, high interest rates, and rigid structures. Economic cycles complicate fiscal sustainability assessment. During recessions, government revenue falls as incomes and corporate profits decline, while spending on unemployment benefits increases. This creates larger deficits when the economy is weakest. During expansions, the opposite occurs. Sound fiscal policy involves running surpluses during good times to offset deficits during downturns, keeping debt sustainable over the full cycle. However, political economy factors often make this difficult. During expansions, there's pressure to cut taxes or increase spending rather than run surpluses. During recessions, there's pressure to maintain benefits and avoid tax increases. The result is often deficits during both phases, causing debt to ratchet upward over time. The relationship between fiscal policy and economic growth is complex and debated. Some argue government spending can stimulate growth, particularly during recessions when private demand is weak. Others emphasize that high debt and taxes may reduce growth by crowding out private investment. The empirical evidence suggests effects depend heavily on context. Debt dynamics ultimately depend on a simple mathematical relationship. If economic growth exceeds interest rates, debt becomes easier to manage, even with continued deficits. If interest rates exceed growth, debt burdens grow automatically, eventually becoming unsustainable. This explains why low interest rate environments allow debt accumulation without immediate crisis, and why rising interest rates create fiscal challenges. Economic history provides invaluable lessons about long-term sustainability, debt dynamics, and factors determining economic success and decline. While every situation is unique, certain patterns recur across different times and places, offering insights for understanding contemporary challenges. First, debt accumulation is not inherently problematic, but sustainability depends on growth, interest rates, and how borrowed resources are used. Debt financing productive investments, generating economic returns, can be sound policy. Debt financing consumption or poorly conceived projects creates future burdens without compensating benefits. Second, economic diversification and resilience matter. Economies overly dependent on single sectors, trade partners, or revenue sources become vulnerable to shocks. Manufacturing capability, even if not the primary economic activity, provides options and resilience that purely service-based economies may lack. Third, inequality and distribution of economic gains have important long-term consequences. While some inequality is inevitable and even economically functional, extreme concentration can create instabilities and reduce growth. Broad-based economic opportunity supports sustainable long-term growth. Fourth, short-term optimization may conflict with long-term resilience. Supply chains optimized purely for cost efficiency may lack resilience to disruptions. Fiscal policies maximizing short-term benefit may create long-term sustainability problems. Economic decision-making requires balancing immediate costs against future risks. The economic forces shaping the global economy today, rising debt levels, shifting supply chains, changing trade and investment patterns, evolving income distribution, follow recognizable historical patterns. Understanding these economic dynamics, the incentives driving them, and the mathematical relationships determining sustainability is essential. While predictions are difficult and the future uncertain, economic fundamentals remain constant. Sustainable growth requires productive investment, sound fiscal management, competitive markets, and institutions supporting innovation and opportunity.